Feroze, lovely to have you on the show again. Thank you so much. I'm going to begin with you. Talk to us. I mean, active investing versus passive investing at a time when markets are volatile. Equity mutual funds have overwhelmingly outperformed the benchmark indices. Same times, contra funds as well. What is the best way forward?
Good evening. Like you rightly said, a large portion of equity funds have outperformed their respective benchmarks, and that's a very, very staggering 82% of them having outperformed. First, to understand the outperformance theory or underperformance theory, we need to understand and have a fair expectation from a mutual fund platform because mutual funds are designed to manage risk. See, return is an external variable, risk is an internal variable. Return you can only pray for, risk is what you manage. That's why textbooks always say risk management, and when it comes to return, they say expected return. Then nobody says return management and expected risk. So that's point. What I'm trying to get to is that when markets fall, when risk happens is when a risk manager starts shining bright. October was one of the bad months from an external variable standpoint, and Nifty fell from its peak on 27th of September from 26,200 odd to almost about 23,850 last week. So October brought some degree of reality check for the markets, and any fund manager who's trying to manage risks looks relatively prettier than the benchmark because benchmarks buy everything depending on past performance. All benchmarks are created and weightages are given. Larger weightage is given to stocks which have performed very well. So that's a growth kind of mentality, and fund managers are value more or less and risk managers. So that's the great news.
Feroze, even within mutual funds, active mutual funds, you're seeing contra funds outperform 100%. That's a staggering number, isn't it?
Yes, it's a staggering number, sure, Krishna. And like Mohit said, that 1 month periods, there could be 1 month periods where all of them outperform. There could be another 1 month period where all of them underperform as well. But in our experience, see, if you're a retail client, then an index fund is still okay because for 20 years you will not buy and sell. But when it looks we are in the business of private wealth management, we have about 11,000 clients. I've made in my model portfolio as an Anand Rathi Wealth almost about 39 changes from 1st of June 2013. And if you look at the alpha generated over index funds, that's a staggering, very large number. So I don't want to put it here. Basically, if you're able to be nimble footed and agile, because mutual funds are cyclical, like HDFC FlexiCap, I exited in my model portfolio in May 15, re-entered that on January 21. Prashant Jain's 5-6 years worst period we were out, and fortunately that's a right call. We also go wrong several times.
Okay.
But net, over the last 5 years, my portfolio would have beaten on a 10 crore base 7 crore alpha. So I would not go with the Warren Buffett strategy, which is go only to index funds because he's sitting in the US at the age of 94. And India is a far more relatively simpler market where you can create alphas if you apply some mind and you are agile enough and married to equity for 20 years, but not married to a scheme for 20 years.
Feroze, that is the question then when it's clear that you've got to be nimble-footed, both of you in concurrence on that matter, how does the retail investor approach this? Because the whole idea is that they're not the money managers, they're not the people who have to do the tough job of tracking the markets. If you have to be nimble-footed, what should be a good split, and who should split it how much? Because age group-wise is a difference, isn't it? Somebody who's investing at 20, somebody who's investing at 40. How do they make that split between active and passive funds?
I personally think, yes, you're absolutely right. A retail investor would want to be, like Mohit rightly said, if you're not going to be moving around, you have to believe in mean reversions, which is a very, very strong principle. So I would say active and passive both might have a role. But I think what I personally think that there's hardly any understanding of industry participants of how indices are created. Okay, if I ask somebody, why do we have 10,000 crore companies not a part of NSE 500? There are 34 companies greater than 10,000 crore market cap, not in NSE 500, in spite of the NSE 500 having 5,000 crore companies. Because there are some rules, there are 6 rules in which NSE 500 is created, and those two of those rules are very, very funny and tricky. So there are quite a few companies which are very large in size, but not a part of NSE 500. They are part of Morgan Stanley's Emerging Market India Index, but the Indians don't follow those stocks in the index. So there is a lot of homework which one needs to do, even buying an index fund. Because if there are 500 stocks, there could be 10 stocks which I don't believe have the best corporate governance. I don't want to invest in them and make money off them or lose money off them, because I fundamentally don't think investing in a company just because of its past performance, it comes into the index, is fundamentally right. And being valuation agnostic. When you invest in index, you are saying that valuation does not have relevance, because higher the valuation, higher the past performance, more the weight. Because all indices in India are created in a certain fashion, which is growth fashion, apart from those index funds which have smart beta as their strategy. So retail should ideally look at indices, but 84% of the money which is there in index funds is in NSE, Sensex and Nifty. That's the reality of it. So 84% is in Sensex and Nifty, and Sensex, 70% of Sensex is in the top 10 stocks, of Nifty is in the top 10 stocks. So there is a lot of homework which needs to be done when you buy an index fund and have your foundation principles right, and if that marries with your thought process.
Okay. Feroze, I wanted your take on ETFs, as the option. Are retail investors better off investing in ETFs or everything else?
I think I would completely concur with Mohit that ETF is another ball game. I think buying an index fund is so much better,
Okay.
because little do people know that there is an STT difference. If I buy an index fund, ETF of Nifty, I spend 36 rupees buying and selling in the form of STT. Index funds have an STT which is significantly lower than an ETF. People love to see the low management fee of an ETF, but they ignore an STT, which is a reasonable, hefty penalty vis-a-vis an index fund. So I personally think an index fund where you buy and sell with the AMC is a better choice for a retail participant. And I don't think the cost, the little incremental cost, is worth. But I think the most important thing when you're buying a passive is to try and see how close to the index has it been. Most 90% of index funds underperform the index which they're supposed to mirror. That is not spoken enough, because you're in an active fund, at least there is a chance that you will outperform. In an index fund, you're sure to underperform by a small margin because of inefficiencies and costs. So that's one thing which you should see. If you find an index fund which has a positive tracking error, great, go for it.
Okay. Wanted to quickly get a check with you. Talk to us in terms of where do you see the markets headed? Nifty at 24K, is that a possibility? Can it settle over there? And generally, because for when we talk about mutual funds, you're also talking to retail investors, telling them how the markets are going to be for the next 6 months, considering all the factors from Trump to what's happening back home.
Yes, Krishna, in my belief, markets have two kinds of corrections. One which I call correction, the other is just a small little second nature of the market. Markets every 10 months have fallen 10% for the last 24 years. That's the average drawdown period which is there in the market. So I think today we are about 8% lower than the peak. So this is a good opportunity for one to enter, in my belief, because I don't see any catastrophic fall and a reason for a catastrophic fall, which is what an investor needs to be worried about. A trader needs to be worried about the next 200, 300 points of Nifty. But an investor needs to be worried about only one thing: is there a catastrophe in the making? If the answer is 99% there's no catastrophe in the making, you can invest, especially when you're not at 52-week highs. If you're 8% lower than 52-week highs, incidentally, you should grab it. That's point one. Point two, according to us, the earnings of Nifty this year have to be 1165. We have finished 2 quarters. 1 quarter is done. There was 262 rupees of earnings last quarter on Nifty. This quarter, so far, 39 companies of Nifty have declared results. 192 rupees is in the bag. So we're looking at 1165 very closely. So that's the earning on a base of 1048 last year. That will be a growth of almost about 10 odd percent on Nifty. So far this quarter, 8% is the growth after Tata Steel declared its result last weekend. So what am I trying to get to is that there is not so much of a froth in the market. If we're looking at 24,000 divided by 1165, which is this year's earning PE ratio, I
Right.
don't think you're getting more than 21, 22. And we'll, in the next 5 months, finish this
Right.
financial year and start discounting next year. So I'm reasonably happy with the valuation. So lump sum investment is what I would recommend after this correction.
All right, we will leave it at that. We're completely out of time on this discussion. Feroze Azeez, Deputy CEO of Anand Rathi Wealth, thank you so much for taking time out to be with us.